Hi there, welcome to Funding by Alex. My name is Alex, and today I would like to talk to you about a phenomenon called mezzanine financing. So, as this is an educational video, I would like to explain first what is mezzanine financing. So, it's actually combining debt and equity. You convert debt to equity, so you borrow money, and then if you can't pay it back on default, you can actually convert the debt to equity, or at least the lender can convert it for you. So there are embedded instruments, meaning when you sign the loan agreement, you include certain instruments where this equity is being converted. So you basically convert the debt to equity. It's already inside of this agreement in the form of warrants. Warrants is, as it says, for those of you who didn't study finance extensively, there is a warrant out for your arrest. Now, yeah, similar to that is a warrant out for equity, obviously. So normally it's an option for lenders to actually get or obtain purchase equity in your company or convert indeed the debt to equity at a certain price which you agree. So a warrant also is something that is an instrument that is traded publicly. So there are various companies that actually issue warrants, especially after IPOs. IPOs, you have warrants for additional stock, that maybe are able to be converted to stock, like maybe in 6 months or 8 months or 12 months, basically after the IPO is a fact. Then mezzanine finance it's actually debt. So you're talking about. It sits basically between senior debt. So senior debt is basically, you have to imagine that if your company goes bankrupt, so someone lends money to you, your company goes bankrupt, who gets the money first? So normally you are talking about tax office, banks. Those are the senior debt holders, basically that order, also tax office, and then banks. So that's the senior debt. Then you have junior debt. So debt is actually something that is everybody you owe money to. And then equity. So you think people who actually have invested money inside in the company and have shares in the company. So the equity is actually something that is junior, meaning those are the people who get the money last out of the business, and usually they are left without anything if the company defaults, because you don't default for no reason. You don't have any money left to no liquidity in sense of running your business anymore. So because it sits there, it's risky, because if a company defaults, obviously you don't get the money back easily. Yeah, there's first the tax office, then the bank, any senior debt holder, any senior debt instrument. Uh, but it actually is senior to any common or regular equity, basically. So if you talk about preferred equity, so that is a bit of a distinction. So subordinated debt is still something that doesn't give you shares, so it's actually a loan to a company. So normally that is the more subordinated the debt is, the more junior the debt is, the higher the interest rate, because the risk is higher, meaning the interest rate goes up. If you're talking about preferred equity, that is equity, of course, that is still senior to the common stock, basically. So preferred equity is normally something that, if let's say the investor will take inside a company, if you're talking about venture capital funds, etc., they will want to have preferred equity. It's maybe non-dilutive or whatever. You're talking about basically the position there is that preferred equity, still there is you get your money from dividends, you get your money from exerting influence in the company and possibly selling your equity. The debt, of course, you don't have any influence on the company, other than the fact that they owe you money, and you basically get interest payments. So that's actually a guaranteed difference. Now, mezzanine debt is usually used to grow established companies. So you're not talking about early stage startups or companies that are pre-revenue or anything like that. They are larger companies that need really something that is quick. So you're talking about, I'm in a cash crunch, or I need to do an acquisition, a quick acquisition, and I need money. Now, anything that is quick is more expensive. You're talking about and higher risk also because these are unsecured debts, so there's no collateral in the regularly it's your unsecured debts. So you talk about somewhere between 12 to 30% interest rate. So 30% is really on the high end, but normally it hovers around 20-25%. So it's quite expensive. But yeah, basically there are there's a maturity. It's a bit like a bond system where you have basically 5-year maturity typically, and of course the distributions, which is the interest payments, are priority distributions. So in essence, before anything else, it's a bit like you know. No, what I just explained is like you have the tax office needs to, of course, be paid the taxes, and the bank needs to be paid their interest payments, and of course, then you also have priority distributions for your interest payments. So that's in a nutshell what mezzanine financing is. So again, it sits really comfortably in between senior debt and yeah, equity, basically. So in essence, this is where I think the sweet spot is for a lot of companies. It's quite high risk because yeah, in the end you are at a risk of being without any repayment, of obviously, if the company goes bankrupt. Because yeah, even though it's junior debt, you still get your money back before the shareholders. But normally, after the tax office and the bank are done with it, who are normally the ones who would file for the bankruptcy or request the court to rule, for Chapter 11 or whatever. Uh, you're talking about yeah, nothing's left after that. So to get your money back in that sense is yeah, quite a long shot. But under normal circumstances, it's quite a high interest loan that lenders can actually provide. And of course, for companies that have no choice, where you say it's unsecured, so meaning you don't have collateral to put up yet, then it can be a quick way of getting the money to do the acquisition, or maybe increase your number of products, or increase your production capacity, or launch something new. Basically, that is normally project-based financing is what it's used for. So let's illustrate this with a simple example. So you have a company that has an existing loan of 5 million with a bank. So they exchange this, so they restructure the loan with a $10 million loan from a mezzanine finance provider, a mezzanine lender. So the interest payments increase because regular bank loans are actually the cheapest source of capital in the world. Then mezzanine financing company, of course, takes on higher risk because their debt is subordinated to bank debt, so they are taking a more junior position with the debt. Therefore, the interest rate increases. The reason that a company wants to do this is because they need an increased short-term capital. So in this case, the short-term capital increased because they want to make an acquisition. So company ABC wants to acquire company XYZ. So they actually are exchanging this $5 million loan for a $10 million loan. So they are basically having $5 million to, this very simple example, $5 million to acquire this company. So they use that money for that. Now, as a part of the deal, the mezzanine lender, can impose ratio requirements and also block additional loans, which means that ratio requirements means that if you are unable to service the debt, meaning you borrow more than you can repay, so the interest payments are really very extreme, that it impacts your ability, your liquidity of the company, basically. That is actually the reason that these sort of requirements are imposed. So they can actually veto any additional loans. So that is something they need to put into the loan agreement, obviously. But in essence, so you don't take on like debt from various other lenders, which maybe in the end takes the company to ruin, and you can't pay it back anymore. Now, if at some point they are in the cash crunch and they can't pay it back anymore, then the equity will convert to the debt will convert to equity. So meaning the company that lends the money, the mezzanine lender, will actually receive shares in the company in exchange for whatever the company that borrowed cannot cannot pay back. So this is the thing that, in an example where the mezzanine lender actually is, exercising that warrant, basically, that we're talking about. That also something they have to put in the loan agreement. So they are actually taking equity in the company, and they're converting the debt, so the money they lend to this company, to equity. Now, in the case of bankruptcy, which of course, you don't hope that something like that will happen when you are lending something to another company, but the mezzanine lender will be after the tax office and after the bank. They will be maybe the last of the debt tier that will get paid. So before anyone who actually invested in the company to buy shares. So this is a simple example of how this would work in practice. Like I said, it's really short-term capital, so people really are in a cash crunch and they need unsecured debt basically to expand their business. They will choose this. If you're talking about people have more time, and of course longer processes, and of course you need to when you put up collateral, there is an entire process of valuing this collateral also. That is something that could work on this mezzanine finance. It's a shortcut to get your hands on more money for short-term investment, and you need to weigh whether, of course, the interest rate actually weighs up against the benefits long term. So this is the thing that you look at. Of course, that mezzanine debt, of course, can be repaid ahead of the maturity date, just to make sure that maybe there are cheaper options. So you restructure a loan by taking out another loan to restructure this if you have a lower interest rate or better terms, basically. Thank you for watching. You can email me at alex@goldendragoncapital.co. Please don't forget to like and subscribe. And if you would like to have more information about options for your company for mezzanine financing, feel free to reach out. We have quite a lot of projects that we have done on this in this tier. Would love to help you out and, of course, provide information. The clock is not running, the meter is not running, as they say, the taxi meter. We are happy to have a chat and see what we can do for you. Thank you. Bye bye.